Hi friends, welcome to JD's guidance once again. Friends, we were discussing risk and return, and in this connection, in my previous video, we have already discussed certain things. So specifically, we have seen what is return and what is risk. Risk return happens to be very important factors while making any investment decisions. Now friends, in the previous video, we have discussed that there are two types of risk. We have the total risk that is divided into two parts, that is the systematic risk and the unsystematic risk. Friends, we have already seen that total risk, it can be measured through statistical measure as well as through certain other behavioral measures or probability distribution measures or through sensitivity analysis. We have not seen that part, but we have seen the statistical measures which are widely used when we want to measure risk. So we have two statistical measures, one is standard deviation and we have the other one, that is variance. So standard deviation and variance will help us know the variability in our returns. This variability in our returns is known as risk. So if I have an expected return of say 20 rupees, to what extent I have the chances of varying from my expectation, either up or down. So this is captured through the standard deviation and variance. Now coming to the systematic risk. Now see, if you can observe from here, the systematic and unsystematic risk together makes the total risk. Now question is, the investors are more interested to know the systematic risk associated with an investment. Why? Because as we have seen in our last video, that unsystematic risk is something which can be diversified, which can be eliminated through our strategic or prudent financial decisions. However, systematic risk is something which we cannot altogether eliminate. We can control it. So that's why we can reduce it. So that's why systematic risk is very important from investors' perspective, because investors are more interested to know what would be the systematic risk associated with the investment. And that is why we have some measure that can capture this systematic risk. And the widely used measure is beta. And in this video, we will just know the concept of beta in a very short way, in a very precise way. In the next video, we will see how beta is computed. Now let's see what is beta. When we say standard deviation and variance to be the measure of total risk, when we get the values, it comes to be in some number. Say 20 is the standard deviation or 8 is the variance. Now what does this mean? This means that a security price has the chances of varying 20 or 18. Now this is an absolute value. This is a number, 20 and 18. But on the contrary, beta is not an absolute measure of risk. Rather, it is a relative measure of risk. Now let's understand why it is called a relative measure of risk. It is called a relative measure of risk because beta establishes relationship between two things. Beta measures relationship between two things. That is, to what extent an individual security, take for example any security, I call it as X, how much it varies with the market. I call it as market, M. So it establishes the relationship of the returns of an individual stock X with that of the market M. So if the market, whereas when I say market means market index, if the market index goes high, whether my stock is going high that way or not. If it falls, whether it is falling down to that extent or not. So this establishes relationship between the individual stock returns and that of the market return. Okay. Now the question is, what is its interpretation? Now, suppose the beta value, you will understand from this, beta value can be equal to 1, beta value can be greater than 1, beta value can be less than 1. Now, if beta is equal to 1, this means that if the market is going high by 1%, then my individual security, if M is going by 1%, the individual security will also go high by 1%. If market falls by 1%, my individual security will also fall by 1%. That means it is going as per the movement of the market at par. So this type of security is considered to be average risky. They are average risky. Not very high, not very low. Coming to if beta is greater than 1. If beta is greater than 1 means if the market goes high by 1%, beta will go high by, individual security will go high by 1.5%. If market falls by 1%, the individual share will fall by 1.5%. Means here the stock is very sensitive to the market movements. Market goes high by little, the share price will go high by more than that. If market falls by little, it will fall by more than that. So it is oversensitive. So as you can understand, these type of stocks are very risky. Why it is risky? Because if the market is going high, it gives you a lot of return. But if the market goes down, it makes you suffer a lot. So this type of securities can be considered to be more risky. They are relatively more risky. Okay. Now coming to beta less than 1, it's just the opposite. If market goes high by 1%, beta will go high, not beta, the individual security price will go high by say 8%. If market falls by 1%, it will fall by 0.8%. So that means the stock price is not very sensitive with the market movement. So this type of stock, of course, it will give you a little lesser income if the market is high, but it will make or protect you from a lot of loss when the market is falling. So this type of securities, we can call it as less risky security. Okay, relatively less risky. So this is the interpretation of beta, and my dear friends, now you understand that how beta is important if you have to know the riskiness of the share or the security, right? Because if beta is equal to 1, it goes with the market. If greater than 1, it is very risky. If less than 1, it is less risky. So that I think makes an idea about what is beta. In the next, we will try to find out how to compute beta. Thank you for watching this video. Stay tuned for the next video. Bye-bye.